What if selling a property at a loss was actually a brilliant strategic move? It sounds counterintuitive, but that's exactly what might be happening with one of Singapore's biggest retail landlords, Frasers Centrepoint Trust, or FCT. They just sold a piece of a suburban mall for $34.5 million, seemingly for less than they paid. But this isn't just a simple property sale. It's a calculated chess move with huge implications for two of the biggest players in the Singapore property market. Stay with us as we unpack how this deal could unlock massive future value and what it signals for investors. Before we begin, a quick reminder. This video is for informational purposes only and is not financial advice. Always do your own research or consult a professional before making any investment decisions. So, what exactly was sold? On August 25, 2025, FCT announced the sale of 10 retail strata lots at the Yishun 10 complex. These are part of a 99-year leasehold property that FCT has held since 2016. The buyer is a company called Lion Singapore Private Limited, a subsidiary of Frasers Property Limited, or FPL. This is a key detail because FPL is FCT's sponsor and largest shareholder, owning nearly 38% of the REIT. This makes it a related party transaction where transparency is absolutely critical. This sale is the final piece of a bigger puzzle. Just a few weeks earlier, FPL had already bought the other part of Yishun 10, the Golden Village Cineplex, for $48 million. So now, with this latest $34.5 million deal, Frasers Property owns the entire Yishun 10 complex. This complete ownership is the real story here. Now, whenever a REIT sells an asset to its own sponsor, the first question is always, was the price fair? In this case, FCT took clear steps to ensure it was. The $34.5 million price was set on a willing buyer, willing seller basis and was determined by taking the average of two independent valuations from industry experts, JLL and Savills. This transparent process is a cornerstone of good governance. The REIT's own Audit, Risk and Compliance Committee publicly stated that the deal was conducted on normal commercial terms and was not prejudicial to the interests of FCT and its minority unit holders. So, what happens to the money? After minor expenses, FCT will receive net proceeds of about $33.8 million. The manager has been clear that this cash is going directly towards paying down debt. While it's a small amount for a multi-billion-dollar REIT, this move strengthens its balance sheet and signals disciplined capital management in a time of rising interest rates. So why did FCT sell? It's all about proactive portfolio management. The Yishun 10 retail lots were a small, fragmented, strata-titled asset. For a giant like FCT, which owns massive integrated malls like North Point City, a small collection of strata units likely required disproportionate management resources for the modest returns it generated. Think of it as pruning a tree. You cut smaller branches to help the larger ones grow stronger. By selling this non-core asset, FCT can recycle its capital and focus on its bigger, higher growth properties. But the real story is on the buyer's side. For FPL, this isn't just a simple acquisition, it's a strategic consolidation. By buying both the cinema and these retail lots, FPL has now gathered all the pieces of the Yishun 10 puzzle. The reason is simple: redevelopment. By gaining 100% control, FPL has skillfully sidestepped the complexities and risks of trying to launch a collective or en bloc sale with multiple owners. They now have a clear runway to demolish the old building and create something new. This move perfectly aligns with the Urban Redevelopment Authority's master plan for the region, which includes building thousands of new homes nearby. Every strategic move has its own set of risks and opportunities. For FCT, the obvious risk is the small capital loss on paper, having sold for about $3.3 million less than its 2016 purchase price. However, a REIT's primary goal is generating stable rental income, not just capital gains. The manager likely calculated that the strategic benefits of cleaning up the portfolio and paying down debt far outweighed this small, one-off loss. For FPL, the risk is all about execution. They've spent a total of $82.5 million to acquire the entire site. Now comes the hard part of getting planning permissions and managing construction. It's a significant bet on their long-term vision, but the opportunity is massive. by transforming a fragmented, aging property into a modern, integrated mixed-use development, they could unlock substantial value and create powerful synergies with their other major asset next door, North Point City. So, what did the market think of this deal? The overwhelming reaction was positive. On the day of the announcement, FCT's unit price closed up 1.78% at $2.29. But FPL's shares jumped by a much more significant 5.26% to close at $1. This tells you everything. Investors saw this as a prudent but minor cleanup for FCT and a major long-term value creation project for FPL. All right, let's boil it all down. What are the simple pros and cons of this divestment for FCT? On the pro side, first, a strengthened balance sheet from repaying debt. Second, portfolio optimization by removing a non-core asset. And third, it demonstrates disciplined capital management. Now for the cons, the main one is the realized capital loss on paper, and second, a slight reduction in income from the property. As you can see, the strategic pros appeared to comfortably outweigh the minor financial cons. So what's the big takeaway from this $34.5 million deal? This transaction is a masterclass in strategic alignment between a REIT and its developer sponsor. It's not just about the numbers, it's about foresight. For FCT unit holders, this is a sign of a prudent manager prioritizing resilience and focus. For FPL shareholders, this is a signal of ambition and long-term value creation. The key lesson for investors is always to look beyond the headline number. A small loss can hide a major strategic win. This divestment is a catalyst, the starting gun for the next chapter of Yishun 10, positioning both companies for a stronger future. What do you think of this divestment? Was it a smart move for FCT? Let me know your thoughts in the comments below. And if you found this deep dive helpful, please hit that like button and subscribe for more analysis on the property and REIT markets. Thanks for watching, and I'll see you in the next video.